Picture this scenario. You wake up every morning, check your bank account, follow your budget religiously, cut unnecessary expenses, and yet somehow your money seems to disappear into thin air. You're doing everything financial experts tell you to do, but your purchasing power continues to shrink month after month. If this resonates with your current financial reality, then you're experiencing one of the most significant yet misunderstood economic phenomena of our time. The harsh truth is that millions of people worldwide are trapped in a financial system that systematically erodes their wealth, regardless of how disciplined or strategic they believe they're being with their money. This isn't about poor financial habits or lack of budgeting skills. This is about understanding the fundamental mechanics of our monetary system and recognizing that the very foundation upon which we build our financial security is deliberately designed to benefit institutions rather than individuals. Take a moment to honestly assess your current financial trajectory. If you continue on the exact same path you're following right now, where will you find yourself in 12 months? What about 3 years from now, or even a decade down the road? For most people, the answer is uncomfortable because they realize they're essentially running on a financial treadmill, expending enormous energy but making little meaningful progress toward genuine wealth accumulation or financial security. Many people place their hopes on external factors beyond their control, such as potential Federal Reserve interest rate cuts or government policy changes. However, understanding what these institutions must actually do to implement such changes often reveals that the supposed solutions may actually accelerate the very problems they claim to address. This creates a dangerous cycle where people wait for systemic improvements that never materialize in ways that benefit ordinary citizens. The root cause of this widespread financial erosion lies in understanding the true nature and purpose of central banking systems. In the United States, the Federal Reserve serves as the central bank, and similar institutions operate in countries around the globe. Most people naturally assume these powerful financial institutions exist primarily to serve the economic interests of individual citizens and promote general prosperity. Unfortunately, this assumption represents one of the most costly misconceptions in personal finance. The reality is that we are currently engaged in what can only be described as a financial war, though most participants don't even realize they're on a battlefield. Central banks and the broader financial systems within which we're compelled to operate don't exist to benefit individual wealth accumulation or preservation. Instead, these institutions serve primarily to enable governments to spend beyond their means, accumulate massive debt loads, and then monetize that debt through various mechanisms that transfer the real costs to ordinary citizens. Every time a central bank engages in what's commonly called money printing, which in modern times involves digital creation of currency rather than physical printing, the cost of this monetary expansion is borne by everyone who holds that currency. This cost manifests as a reduction in purchasing power, meaning that each unit of currency becomes capable of buying fewer goods and services over time. Understanding this mechanism is crucial because it explains why prices for basic necessities continue rising even when people feel they're managing their finances responsibly. The purchasing power of major currencies, including the US dollar, faces systematic destruction through this process. What requires $1 to purchase today will require increasingly more dollars to purchase in the future, not because the underlying goods or services have become more valuable or costly to produce, but because the currency itself has been deliberately devalued. When consumers notice that everything costs more at the grocery store, gas station, or retail outlets, they typically refer to this phenomenon as inflation. However, this represents a fundamental misunderstanding of the actual economic process at work. Rising prices are not inflation itself, but rather the visible consequence of inflation. True inflation is the monetary expansion that precedes and causes price increases. The actual inflation occurs when central banks inject additional currency into the economic system. Citizens then experience the results of this monetary expansion through reduced purchasing power and higher prices for goods and services. This distinction is critical because it helps explain why traditional approaches to combating rising prices often fail to address the underlying cause. Consider a historical example that illustrates this principle clearly. In 1955, a person could purchase a McDonald's hamburger for just 15 cents. Today, that same basic hamburger costs many times more. The hamburger itself hasn't fundamentally improved in quality or become more expensive to produce relative to other economic factors. What changed is that it now requires significantly more dollars to purchase the same product because those dollars have been systematically devalued over decades. This example demonstrates why many people find themselves on what feels like a financial treadmill. They may be increasing their income, following budgeting advice, cutting expenses, and implementing various financial strategies, yet they struggle to get ahead financially. The problem isn't their personal financial management skills or discipline. The problem is that the currency they're earning, saving, and budgeting with becomes less valuable over time. Unless individuals can consistently invest their money in assets that appreciate faster than the rate of currency devaluation, they will inevitably lose purchasing power regardless of their other financial decisions. This creates a challenging situation for people in every country operating under similar monetary systems, because the game is essentially rigged against currency holders in favor of asset holders and debt issuers. Another fundamental issue with modern monetary systems is their fiat nature, meaning they're based on currencies that have no intrinsic value or backing by tangible assets like gold or silver. These currencies exist essentially as paper or digital entries backed only by government decree and public confidence. When central banks create additional units of fiat currency, they dilute the value of all existing units, which directly causes prices to rise and purchasing power to decline. This explains the mechanism behind the vanishing money phenomenon that so many people experience. It's not that their budgeting skills are inadequate or that they're making poor financial choices. Instead, they're trying to build wealth using a medium of exchange that's systematically designed to lose value over time. However, this seemingly hopeless situation actually contains significant opportunities for those who understand the dynamics at work and take appropriate action. Throughout human history, certain strategies have proven effective at preserving and building wealth, even during periods of currency debasement and economic uncertainty. The most historically proven and battle-tested solution involves diversifying wealth into precious metals, particularly gold and silver. These physical metals have served as stores of value for thousands of years across virtually every civilization and economic system. Unlike fiat currencies, precious metals possess intrinsic value based on their physical properties, industrial applications, and universal recognition as valuable commodities. The key insight is that measuring all wealth in terms of a depreciating currency represents a fundamental strategic error. Consider an investor who achieves a 10% return in the stock market during a year when currency devaluation effectively created 12% inflation. Despite appearing to make money, this investor actually lost purchasing power. Many people discover that while their nominal asset values may increase over time, their real purchasing power remains flat or even declines when properly adjusted for currency debasement. In contrast, those who hold gold and silver as financial insurance and inflation hedges often find that their wealth not only maintains its purchasing power, but actually grows in real terms. Gold serves multiple functions simultaneously. It acts as financial insurance against monetary system failures, provides a store of value that maintains purchasing power over long periods, and functions as an effective hedge against inflation and currency debasement. This strategy focuses on wealth preservation and gradual accumulation, rather than get-rich-quick schemes or speculative investments. The mission involves helping people understand that they can take concrete steps to preserve their purchasing power and build genuine wealth even within a system designed to erode individual financial security. Two common objections arise when people first learn about precious metals as a wealth preservation strategy. First, many people believe they don't have enough wealth to make precious metals relevant to their situation. Second, others worry that gold prices are currently too high, having reached all-time highs in recent years, making it too expensive to begin purchasing. Both concerns can be addressed through proper understanding and strategic thinking. Regarding the first objection, virtually anyone with any savings at all can begin transitioning some portion of their currency holdings into precious metals. The strategy doesn't require massive wealth to begin implementation. Even modest amounts invested consistently over time can provide significant protection against currency debasement and inflation. The goal isn't necessarily to purchase precious metals from any particular dealer or company, though working with reputable and trustworthy partners obviously makes sense. The crucial point is understanding the importance of converting some portion of depreciating currency holdings into gold, silver, platinum, or palladium, which serve as stores of value and hedges against inflation. These metals essentially function as financial insurance policies against monetary system failures and currency debasement. Keeping all wealth within a broken monetary system represents an unnecessarily high level of risk. Diversification into hard assets that have maintained value throughout history provides a logical hedge against systemic monetary problems. Regarding the second concern about gold prices being too high, this objection typically comes from people who don't understand the fundamental drivers of precious metals pricing. For years, people have claimed that gold is too expensive at various price levels, yet it has continued appreciating over time. Those who made this argument at lower price levels missed significant opportunities for wealth preservation and growth. The primary factors that drive gold prices upward are the same forces causing widespread financial difficulty: erosion of purchasing power, currency debasement, and monetary expansion. As currencies lose value, gold and other precious metals maintain their value and often increase in value because they move in the opposite direction of currency debasement. This inverse relationship makes precious metals particularly valuable during periods of aggressive monetary expansion. Consider the logical implications of current monetary policy trends. Will the erosion of purchasing power continue in the United States and other countries operating similar monetary systems? Will central banks continue creating new currency to monetize government debt? Will they continue reducing interest rates to stimulate economic activity? The answers to these questions provide insight into the likely future direction of precious metals prices. Many people anticipate that lower interest rates will solve various economic problems and improve their financial situations. However, understanding how central banks actually reduce interest rates reveals why this expectation may be misguided. Central banks don't simply decide to lower rates and send emails announcing the change. Instead, they purchase government bonds and other securities to drive rates lower. This bond purchasing requires creating new currency, which represents additional monetary expansion. Therefore, interest rate reductions actually involve more money printing, which creates higher prices and further erosion of purchasing power. The supposed solution becomes another driver of the original problem. This cycle explains why traditional economic remedies often fail to provide lasting relief for ordinary citizens while potentially benefiting asset holders and financial institutions. The evidence for this perspective includes the intense opposition toward physical precious metals ownership, expressed by Wall Street and other financial institutions, combined with the remarkably low percentage of individuals who actually own physical metals. This opposition exists because financial institutions want people to keep their wealth within systems that generate fees and profits for intermediaries. Physical precious metals ownership represents wealth held outside traditional financial systems, which reduces the fees and control that institutions can extract from that wealth. The recommendation involves maintaining minimal currency holdings sufficient for daily operations and bill payment, while converting available surplus into physical metals that serve as financial insurance, stores of value, and hedges against inflation. As central banks reduce interest rates, this monetary expansion typically provides significant upward momentum for precious metals prices, making lower rates essentially rocket fuel for gold and silver appreciation. This strategy requires education, planning, and implementation, rather than hoping that external forces will somehow improve individual financial situations. The solution lies in understanding monetary systems well enough to protect wealth from systematic erosion, while positioning for potential appreciation as these systems face increasing stress. The path forward involves taking personal responsibility for financial education and wealth preservation, rather than relying on institutions that have different incentives and priorities. Those willing to learn about precious metals and implement appropriate strategies often discover that these metals can literally save their financial lives by preserving purchasing power and building real wealth even during periods of monetary chaos and currency debasement. Understanding these concepts and taking appropriate action can transform financial trajectories dramatically. The choice involves continuing to hope that a broken system will somehow start working in favor of individual wealth accumulation, or taking control by diversifying into assets that have preserved wealth throughout human history. The evidence strongly suggests that precious metals represent one of the most reliable methods for achieving genuine financial security in an environment of systematic currency debasement and monetary expansion. The opportunity exists right now for those willing to educate themselves and take action. The same forces that are destroying purchasing power and creating financial difficulty for unprepared individuals are simultaneously creating tremendous opportunities for those who understand the dynamics and position themselves appropriately. The difference between financial struggle and financial security often comes down to understanding these systems and making informed decisions based on historical precedent, rather than wishful thinking about institutional solutions that have consistently failed to materialize.